Too big to fail. That's what you might think when you think of the Walt Disney Company. You think of the magic, the mouse, and the money. But there's something darker going on. Rumblings and disillusionment rack the kingdom, and Disney finds itself thrust into chaos. With recent C-suite departures and multiple activist firms elbowing their way to the top, let's cut through the noise and discover what's really threatening the House of the Mouse. Again, when you think of Disney, you think of its sheer size, its plethora of IP and companies, and all of its cash and assets. But the reality is that Disney is in a bit of trouble. But that's the very reason why Bob Chapek left and the illustrious Bob Iger took over again. Right? Well, on the surface, Disney is on an incredible roll. The parks have reopened with promises and signs of needed improvement and care. Disney Plus is a hit and rapidly growing, and a string of blockbuster movies have just released. It seems like nothing can stop this behemoth, nothing besides Disney, of course. In fact, Disney stands as a very real threat to itself. Or at least that's what inspired activist investor Nelson Peltz to take a special interest in the House of the Mouse. His firm, Trian Partners, formerly released a long and detailed report on a list of issues Disney faces and seeks to take a board seat to help steer the company around. Disney is no stranger to activist investors. Just a few months ago, Dan Loeb urged it to spin off ESPN, but Disney dug in its heels and repelled the idea. Loeb eventually conceded, but still managed to win a board seat. Despite Disney's early pushback against Peltz and Trian Partners, I think it's worth taking a look at the firm's report, since I actually agree with many of the points made. A few of Trian Partners' main objectives are to get a board seat to enforce Disney's CEO succession plan, help the company deleverage, and eventually reinstate its dividend, all in the next 2 years. Trian also believes that by fixing the board's compensation structure, it can incentivize the board to make better decisions. However, finding a suitable successor to the empire seems to be at the forefront here. This goal could very well be one of the hardest of Trian's chief objectives, since historically Bob Iger has submitted multiple resignation letters with definitive dates that came and went. When Iger did finally step down as CEO, he came back to the job within 2 years of his replacement, Bob Chapek, taking on the role. Now, we can speculate whether or not Chapek was framed as the fall guy for Disney's recent and rather large blunders, from nickel and diming, ridiculous spending on streaming, to acquisitions. And speaking of acquisitions, let's take a look at a few that have landed Disney with this massive, nearly $50 billion debt. This incredible slide shows how Disney, despite over $160 billion of spending on improvements, has seen its profit per share fall in half. After pouring massive amounts of money into the Fox acquisition, around $71 billion worth, and spending on movies and TV shows, this has produced a negative effect on Disney's overall profit. And to further illustrate this point, Disney tried and failed to massively overpay for the British broadcasting company Sky. Eventually, Comcast won the bid and paid nearly $40 billion for a company now worth approximately $10. Sounds familiar, doesn't it? While the acquisitions and attempts are bad, the thing that's downright confusing is Disney's performance in the streaming wars. You'd think it was dominating the market, but it's not. In 2022, subscription revenue from Disney Plus approached nearly $20 billion. However, after total expenses, Disney instead saw a loss of $4 billion. Compare this to Netflix, which pulled in 50% more revenue and made $10 billion more in profit. How did that happen? Doesn't Disney have the best IP in the world? On top of that, Disney doesn't even expect to turn a profit on streaming for another 3 full years. How sustainable can that be? Furthermore, where Disney is really losing is where a lot of that money actually goes. Competitor Netflix is handedly beating Disney in every area, achieving profitability at scale. All these problems indicate the magic at Disney is in serious danger. But what if Trian Partners is actually wrong? Sure, Disney engaged in some less than favorable M&A deals, but what company hasn't? Fans may feel undercut with a loss of value at the parks or with movies or shows for the prices they pay. What company hasn't faced that as well? Disney has built an impressive, powerful catalog of brands through these acquisitions. On top of that, it managed to create deep synergies across the entire business. The strategy is safe. Wait for another company to create the next blockbuster idea, buy them out, and then add them to Disney's house of brands. funds, it's a very, very safe idea, though it might mean that Disney itself won't be at the forefront of innovation like it has in the past in the entertainment space, whether that's been through movies, the parks, or other avenues. However, it makes for a stronger, more predictable company overall. You know who is at the forefront of innovation? This channel, so be sure to like and subscribe and help us grow even stronger. With Bob Iger reprising his role as CEO, it could also mean that Disney is reverting back to where it was 3 years ago with his departure. Take into account too that most of Trian's comparisons are 4-year comparisons, with Chapek having occupied most of that time as CEO. If you talk about streaming, you can also make the argument that Disney spends a lot of money up front in order to capture a customer base first, then later focus on profitability, and that's actually what Netflix did too for years. Spend all that money to build up and build out the business, then act to make it profitable. As much as many of the fans despise this, the parks provide a perfect prop for the overall business while Disney focuses on streaming. Again, if we revisit the current debt problem, Iger can boast a long history of diligently paying down debts and helping Disney deleverage. Even if it means the company will have to cut close to the bone over the next few years, the debt should come down. But in the end, I'm just interested in how this whole battle between Disney and Trian Partners plays out. Is Disney its own worst enemy, or is Trian making a bigger fuss than necessary and Disney has simply hit a rough patch? Leave a comment below what you think. I'm not a shareholder, so I don't have a stake in the company either way, but for those of you who do, the biggest thing you can do is vote. Unless either Peltz or Disney relents, the board spot he wants will come down to a shareholder vote. Do your research, read the report for yourself, and make your own conclusion. If you think Peltz does deserve it and believe he and his firm can turn Disney onto a better path, then vote. Even if you only have a single share, your vote matters. But that's all I have for you today. If you enjoyed this video, you'll probably like the one on screen too. As always, this is Dollars and Cents, helping you make sense of making dollars.